friends. Today in this session on success at CA examination, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now student, in this session today we are taking up the paper of Advanced Financial Management, that is paper number 2, final level. Of course, since we are very near to the examination, so I hope you must have gone through your all the topics. So now in today's class, I will mainly concentrate on the mock test paper, two mock test paper that has been held recently. So first of all, in this mock test paper, why this mock test is important, very important, as I told you in the earlier session as well, because it is a kind of a net practice that helps you to avoid those errors that you can generally commit at your examination. Now here, since you are doing this practice here, so it will help you to avoid these errors. So now let us start with our first of all mock test one. In this mock test, both mock tests, first of all, I will take up the case scenarios, because case scenarios are very important part. These case scenario consist of 30 marks, and in my opinion these 30 marks are very easy to obtain. So but you have to be very conscious and you have to be very careful, because the choices given in the multiple choice questions may be very much similar. Okay, sometime it may confusing somewhere also, but you have to maintain your balance, and you have to see that which option will be the correct option. So let us start with the first. I am starting with the MTP1. Okay, so let us start with the MTP1 question, case scenario questions. Then we will move to series 2. Okay, just have some patience. शेयरिंग के लिए कैसे करना है इसको? इसको मान लिया ड्रैग करके शेयर ऑटोमेटिक शेयर जो अपने आप ओपन करेंगे यहाँ पे कहाँ नजर तो आ नहीं रहा, अच्छा आ रहा है, ठीक है. Okay students, now let us see. Now this is the case scenario 1. Okay, this case scenario is basically relating to the topic of your chapter number 9, that is derivative Okay, so here the question is like that. There are two friends. Okay, one is since there are two friends, since Y has earned a lot of profit from the trading in financial derivative market, X is also considering to speculate. Okay, very important. Although derivative is generally used for hedging purpose, but here the question is of for the speculation on Gamma's corporation share, which is currently trading at rupees 700 per share, through taking position in options in the stock of the same company. Okay, so he will take the positions. The positions can be call position, okay, or we can say it's a put position. Now please remember students, generally whenever we talk about the position in the futures, generally they are the long position and short position, that is buying the futures or selling the future. But here, since it is a position, whenever we talk in put up in a context of option, so here the same will apply. Only the difference is that here it will be the long call, means buying, we are buying the call option. Long put, we are buying the put option. Short call, that is we are calling the selling the call. And long call, sorry, the short put, long call, we are selling the call option, and short put, we are selling the put option. So that way we goes on. Okay, now here what he is doing, he is taking a contract position in the option on the Gamma stock. So purchasing one contract of the 2-month call option. So it means he is taking a long call. Okay, with a premium of rupees 35 at an excess price of 750. The purchasing of one contract of 2 month put option. Okay, so he is long put. Okay, at a premium of rupees 25, at a exercise price is 600. Okay, after some time trading in the option market, understanding the nitty-gritty the same of the same, X being the CEO in a organization advised his team to implement the concept of financial options in capital investing called the real option. So there is a separate section for the in our study material where, or even our syllabus, where the application of option techniques is used in the capital investing, and that is called real options. Now assuming that the contract size of each contract is 100 and the price of the Gamma Corporation of the share falls to 500, the net payoff of the X will be. Now here what he has taken the two positions. Okay, so when he has taken the two positions, call is at rupees 750. Okay, and put it as rupees 600. Okay, now it is very important to note that when we have to exercise the options, because option means it is a right or a choice, not an obligation. So generally it is always exercised when it is beneficial. Now here it says that now after 2 months the price falls to 550. Now in that case what will happen? So we will not exercise our call option because we want like to buy the same share at 750 wherever it is available in the market at 550. So in that case we lapse our call option. Okay, now when we come to the put option, that is we have bought at 600. So long call means long put, we have bought it at 600 means we will sell the same stock or option on the same stock to the other person at a 600 rupees per share. So accordingly, since the price now 550, so we will say we will sell you at rupees 600. Okay, so we will exercise this option. Okay, we shall exercise our put option. Okay, on exercising this put option, what is our gain? But this is our gross gain. Okay, but we have to see how much premium we have paid. We have paid two premium. One is 35, another is 25. Okay, so 35 plus 25 equal to rupees 60 into 100. So 6,000 ultimately we have outflow. So from 5,000 we are outflow is 6,000. So accordingly we are having a sorry, 1 second. We are having a loss of rupees 1,00,000. Okay, student. Now I hope it is clear to you. Now we are coming to the second MCQ of the same case scenario. The price the per share price of Gamma Corporation stock after 2 months at which X shall be at a break even. So break even means I don't have to tell you, it is basically no profit, no loss. Okay, so now we have to imagine, or we have to foresee a situation where there will be a break even at this price. So somewhere we can say that we have to see at which price it will be there, because what happens, we have to see the gain from one option is compensated by loss from the other option or premium, whatever it is. Okay, now we can say otherwise also, how much total premium we have paid, 35 plus 25, so rupees 60 we have paid a total premium. Okay, now how we have to compensate? See, it says that the price at which the share of the Gamma Corporation stock after shall be at break even. So overall ultimately we have paid a premium of 60. Okay, so what we do, we say that our strike price is basically, or we can say that 600. Okay, because we can see that here our exercise price, because we can see that, okay, this way, other way also, uh, okay, so we are see, we have to see here, it is very important that it can be viewed from the two angles. One is from the put angle or another is from the call angle. So now if we see from the put angle, so this much of price will be at a price at which there will be break even. However, there is another possibility. Please remember, this we have viewed from the put option viewpoint. Now it is same viewed is from the call option point of view. So then what will happen? Our premium is 60, okay, and our call option exercise price is 750. Okay, now when we say 750, so 750 plus rupees 60, so it will, the answer will be the 810. Okay, so it can be both ways. So since 810 is not an option there, so we are ruling out this option. Okay, next is, which of the following statement is false regarding Ajit, मेरी बड़ी बोतल लाते बाहर से. Now, which of the following statement is false? Statement is false regarding a real option. So options are: real methodology is an approach to capital budgeting that relies on option pricing theory. Of course, yes, we says it is a correct option. This is not a correct. There is no false. It is a true. Now, real option approach is intended to supplement or not to replace capital budgeting analysis based on standard discounted cash flow. Yes, true. Okay, real options are different from the financial options as their period start from the end of the first year. Yes, very true. Because generally in capital budgeting we have to take the decision after first 1 year. Now real options are normally traded in the market and are priced. No, this is wrong. So that's why the correct option will be this. Okay, student. Now we are coming to the next case scenario, that is case scenario number 2. Now this case scenario is basically on the topic of merger, acquisition and corporate restructuring. That is the second last topic. Now let us read this case scenario. P Limited is studying the possible acquisition of Q by way of merger. The following data are available. Okay, so this is after tax earning, number of equity share, market price per share, book value per share. The merger shall be gone through by exchange of equity shares and the exchange ratio is set according to the different ways assigned to the different bases as follows. So it is just kind of a weighted, we have to calculate the weighted average because we are assigning different weights. The Schwab ratio is based on the given weight as follows. So we have to, the given weights shall be, now we have to compute this ratio. So very simple, is there is not a problem because 50% is allowed. So this is on the basis of EPS. So for calculating the EPS, what we shall do, we shall after tax earning divide by this. Okay, so it is basically our EPS comes rupees 5 here, it comes here 6. Okay, so now P Limited is acquiring Q Limited. So it means we can see that the Q Limited EPS is more than EPS of PE Limited. So we can say this will work like this. So accordingly it will come 0.60. Okay, market price. When we talk about the market price, here the market price is low. Okay, now we come to the next book value. So book value is accordingly P's big book value is more. Okay. Okay, we aggregate all of them, so we got the value 0.925. Okay, so here there are four options. Of course, the correct option will be option B. Now we come to the next question. Based on swap ratio, as per assigned weight, the number of shares issued by P Limited to Q. So here first when we have computed this ratio, so our almost we can say our half battle is won. Once we have won the half battle, so we have no problem. We have number of shares of Q Limited with us, that is 50,000. So we multiply 0.925 into 50,000. The figure comes, okay, so the correct option is A. Okay, now we come to the next post merger EPS. It is as I told you, so we can see that here once we have got the number of new number of issued we have to make, that is 46,250. Earlier the number of shares were 2 lakh, so total new number of shares will be 2 lakh. Okay, our total earning is 13 lakh. So our answer comes 5.28. Accordingly, the correct option is C. In case Q Limited wants to be sure that its EPS is not diminished by the merger, the relevant exchange ratio to achieve the same objective shall be. Now student, here it is always remember that whenever this type of a question is there, you remember only one thing: we have to make the swap ratio based on EPS. Okay, now since EPS with us 5:6, okay, 6:5. So for each share of Q Limited, 1.2 share of P Limited will be issued. Okay, so the correct option is, okay, or we can say that somewhere like that. Since it is 1, so we have not mentioned it. Okay, so I hope this question is clear, case scenario is clear to you as well. Now I am coming to the next case scenario. Case scenario number 3. Now here it says the following information is available in respect of bond A and bond B. Okay, bond A, this is the scenario. Bond B, here it is value same, redeemable value same. Okay, there is a difference of only coupon rate. Of course, the difference is in tenure as well. We can see that the bond which have a longer tenure is having a less coupon rate of interest. Okay. Okay, an investor has a portfolio consisting of 75% of the bond, okay, 25% of bond B, and the YTM, the current YTM prevailing in the market is 10%. So it is having given to us. From the information given above, choose the correct answer to the following questions. Now, first of all, we have to calculate the two things. One is price of the bond and the duration of the bond B. So for duration, first of all, we have to calculate the straight value or the price of the bond. Okay. So now let us see how we can calculate it. This is the period. Okay, now what we if we say cash flow, so the coupon is, see, in a case of a, it is a case of bond B, sorry. Okay, it is a case of bond B, and you have to take care because whenever you are attempting the question, okay, so 10% at the rate. So here we can see that for the this, and in the terminal year, bond along bonds maturity value, that is 1000, along with interest, it will be repaid back. Okay, now we have to take the discounting factor. Okay, since here we can see that it is mentioned that the YTM is prevailing at a 10%, so it will be the considered as a discounting factor. Okay, and we have been given these values, so we shall use, please remember student, whenever any value has been given in the question, so use the same values. Okay, if nothing has been given in the present value factor, so my request to you, at least consider up to 3 decimal point. So these are point I am sharing with you during my our discussion. All important points will be covered here. Okay, so present value comes, okay, when we have to compute the duration, so what we do, we multiply corresponding year with this present value. Okay, so accordingly PV into year. Okay, so somewhere we are considering this value. Now here we can see that when we have received how the duration will be completed, we can compute like this. Okay, so somewhere the duration will come 2.74. Okay, so here we can see there are two options, 2.74, but there is a difference between these two options, that is price. Price is somewhere near about 1000, it is 99 this, so we say our option is B. Okay, so I hope it is clear to you now. Now we are moving to the next question, that is question number 9. The price or the duration of A shall be. Now here we have to compute the bond A. So same procedure we will apply for the bond A. Only the difference here is that the period is 5 years. Okay, cash flows our this 60. Okay, so this will be our price here. So we can see here that somewhere we are nearby this. So our first part we can say that it is almost matching, but we have to calculate our other part as well, that is duration. So accordingly what I do, I multiply it with the year. Okay, we divide it by, so our answer comes 4.41. So our option A will be the correct option. Okay, student. Now with this we come to the next question, that is question number 10. The price sensitivity of the portfolio approximately is, now here we have to calculate the Macaulay duration. Okay, and the formula for Macaulay duration is duration divided by 1 plus YTM. Okay, duration of portfolio. So we have to first calculate the duration of portfolio. So duration of the portfolio is basically the weights, that is 0.75 into we are investing, he is investing 70. See here, he says that 75% is investment is, 1 second, in a bond A and 25% in bond B. Accordingly, the overall comes 3.993. Okay, so 3.993 divided by 1 plus 10. Okay, so the answer becomes 63. Now here you will say, sir, why it is negative prefix? Now student, please remember that whenever price sensitivity is shown, it is shown by way of minus sign, because it clearly indicates that if the price YTM rises by some percentage, the value will of the bond will be fallen. So that's why always it is prefixed with the minus sign. Now if so, here you have been given the choice 3.63 only. There is a choice, so it will be incorrect, because with the increase in the YTM, the value of the we can say that the change in the value of the bond will be negative. Okay, so that's why it is in reverse direction. That's why it is used here. Now we are coming to the case scenario number 4. Now let us, this case scenario is basically, now this case scenario was basically on the topic of security valuation. Here the next case scenario is on the topic of chapter number 3, that is your advanced capital busting decisions. Okay, now read the question in 2 minutes, then we will solve the same. Now it says that XYZ Limited is a mid-sized manufacturing company that produces industrial equipment. The company is considering a new investment project, a state-of-art authorized production line, which is expected to improve production efficiency. The detail of the same project is this: the initial cost is there, sale price and cost per unit. Okay, sales volume has been given, the applicable discount rate is 10%. Okay, from the information given, choose the answer to the correct question, following question. Now first of all, it is somewhere related to the sensitivity analysis. Now here we have to see what exactly sensitivity means. So basically sensitivity means to analyze which variable in a capital busting decision is more sensitive to the, or we can say that degree which with a change in the each variable affects the NPV. Okay, so accordingly we can say that the correct option is before us, option C. So it was a very simple question. Now when we come to the question number 12, okay, MCQ, it says that the sales price per unit so that the project would break even with zero NPV shall be approximately. Now here it is very important. Now when we talk about NPV 0, so generally in case of a sensitivity analysis, we have to see at what rate the price of the we can say at what change, by what change in any variable the NPV will become the 0. So here it is saying the first sale price per unit. Okay, our current sale price is 60 rupees. Okay, and we have to see how much change. Okay, so now let us see how we compute this change. Okay, so very simple. We shall compute, but what we do, we say let S be the sale price at which NPV will be 0. Okay, it means our project cost, NPV means 0 will be that PV of cash inflow is equal to project cost. Simply. Okay, now let us see, since our S minus sale price is 40, okay, number of units sold in a year 1 is 20,000. Okay, as the price shall remain for the all period, fixed cost this cost will remain per year, only this is a 30,000 plus S minus 40 into 30,000. Okay, so here what we do, we discount using the discounting factor very simply. Okay, now when we solve this, and this will all be equal to our project cost, and project cost is 10 lakh. Okay, when we solve this equation, so the value of S comes 55.26. Okay, student. So here our correct option is B. So almost we can see that once we have achieved this, now next part will be very quite simple. The cost per unit so that the project would be break even with the 0 NPV shell. Now here in earlier it was a sale price per unit. Now here it is saying cost per unit. Okay. Now if sale price is rupees 60, now here it will remain the same. Okay, it will remain the same. It is very important that we have to maintain it. The sale price will be maintained status quo. Okay, only thing is that what we see that if our sale price, okay, if our sale price is 55.26, we were achieving the we can say that our NPV was 0. So we can take some clue from here as well. Okay, we can take a clue from the here as well, because see what happens, our cost is 40. Okay, so here our margin is 15.26. So at 15.26, at 15.26 our margin of 20 our NPV is negative. So considering the same, our sale price is same 60, and our at this margin 56.26 our NPV is becoming 0. So the justified cost per unit stands at rupees 44.74. Student, please, here I need your attention. Now please, very importantly, you have to check it. Now here at 55.26 our sale price was, at this sale price our NPV was 0. Okay, now at this our selling cost was 40. So it means 15.26 per unit of margin on per unit is bringing it near to the zero NPV. Okay, it is bringing us to the zero NPV. So accordingly, what we do, we consider this margin as our basis. Okay, and our existing sale price is 60. From this we deduct this. So ultimately we say that this is a justified cost at which our NPV will be zero. Okay, so this is our answer. Now if you want, I can show you, we can verify it as well. Okay, you will say, sir, now let us how check its verification so that you can be doubly sure. Okay, we multiply here present value factor. So somewhere it is nearby our 10 lakh. So we can say that here we can see that at this point when the sale price is 44.74, our NPV will be the zero. Okay, student, we are coming to the last question of this of case scenario of this mock test. Okay, now in this case, an A in the initial outflow will increase lead to a project break even, or sorry, second last question. 14 overall in the this will lead to the project to break even with the zero NPV. So here we have to see whether it is increase or fall. Now student, please remember, whenever we have already a positive NPV, so somewhere what we see, generally a fall in the private in the sale price, that is inflow, will lead to the see, when we are already positive, how we have to make it zero, because we have to approach to negative. So we will inculcate negative values in our this values addition. We will make some negative changes, only then it will we will get our NPV zero. So first of all, there are two possibilities, that is fall will be there. Okay, now fall of 23.868% or 31.03%, that we have to check. Okay, now let us see how we can compute it. For this, first of all, we have to calculate our existing NPV. First of all, we have to calculate the existing NPV. Margin is our 2020. Okay, so ultimately this is our cash flow. Negative, what we minus it 10 lakh, so our NPV becomes 3 lakh 9,800. Okay, now in this scenario, what we do, we see our sales volume. So what, see, we have to reduce this volume. Okay, how much value we have to reduce? We have to reduce this value. So see here what happens, our value volume is not fixed for each year. Okay, it is varying because in the first year it is 20%, then in next year it is 30%, 30,000, and the first year it was 20,000. So what we do, we overall consider a collective value, and collective value is 3098. Okay, so what we see, we say how much decrease fall. So this much of fall shall be required in our sales volume overall. That will lead to our NPV equal to 0. So it is somewhere technical. You have to remember in mind, because here if we have been, the volume has been the same in the each year, then we have followed this approach. If the volume is the same each year, we have to follow this approach. Let V be the volume. So here 20 we will assume the V. Okay. Here sale price will be 60, post price will be 40. Okay. Accordingly, then we have to analyze the same. But since here the volume is different, it is scattered, or we can say diversified, not the same for the each year. We have to do like this. This is one of the very important point that is to be noted. Okay, then it comes the dash n dash in the initial outlay will lead to the project to break even with 0 NPV. Initial outlay. Now we are considering here initial outlay. So very simple. In the initial outlay, we have to see first of all whether it is will be increase or fall. As I told you, to make the NPV our 0, we have to decrease our falls, decrease our cash flows. To decrease our cash flow, what we have to do, we have to increase our expenditure. Okay, so we can say that our first of all we shall consider the case of increase. Now how much I have to increase it? Now let us see it. So we have to increase the initial outlay by 3 lakh 9,000 on the figure of 10 lakh. So somewhere it comes 30.98. Here there is no figure here, so it is one of the nearest figure. So we shall take this. See student, in this type of a question there may be some difference due to rounding off, because since clear cut instruction has not been given, it might be possible that if you have taken the 4 up to 4 decimal point, so this, but here you have to take the option, so there will be not an issue. Okay students, so with this we have come to the end of MTP case scenarios of MTP 1. Now I am taking the MTP 2. Okay student, now let us see the case scenario 1 of the MTP 2. it says that case scenario 1 first, or the MTP2, the data given below relates to the convertible debenture. So it is topic relating to again security valuation. Okay, the face value is given to you, the coupon rate, the number of shares per bond. Okay, the market price of the share, state value of the bond. State value of bond means price of the bond. Okay, that is we have computed using the YTM. Okay, we can use the, it is basis is the YTM. Okay, the market price of convertible bonds, okay, is rupees 550. From the given above information, choose the correct answer to the following questions. Okay, now we have to compute the answer. First, the stock value of the bond. What is stock value? Now, student, please note that stock value means we can say that here if we buy the bond, okay, and if we go to sell into the market, so of course we know that the bundle of a shares is called stock. Okay, bundle of the stock shares called stock. Now whenever we say that bundle of shares, so bundle of shares, how much bundle in this stock? It is number of per bond, that is 25. Okay, each share carries a value of rupees 20. So this will be the stock value of the bond. Okay, student. Now next is the percentage of downside risk based on the market price of convertible bond. Now what exactly is this? We have to see what is downside risk. Now students, see here that if we see that here the market price of the convertible bond is 550, okay, and state value is 400. It means somewhere we can analyze that value of the bond will not go below this 400, and it is also called the floor value. Okay, it is also called the floor value. So in any case, this value will not be go below this value. Of course, today this bond is trading at 550, but tomorrow it might be going up or it may be go down. But please remember, even if we carry the bond till the maturity, okay, at a current YTM, we are getting the 400 price at a market. So here we can say that it is somewhere, it is we can say it is somewhat, we can call it as our near to the we can say that below this we are the floor value. We can say that it is a kind of a floor value. So percentage of the downside risk based on the price of a convertible bond. So what we have to consider, the base of market price. Okay, so 550 minus 400 divided by 550, because very importantly we have to consider the market price base. If nothing has been mentioned, there are two possible answers. It can either be on the cost price, or it can be on the market price, or on the state value. Okay, so we multiply it with the 100. So we get the answer this. Okay, now next thing, what is conversion premium? Conversion premium means, see, we are making some conversion premium means we can say that how much payment we are making, how much payment we are making for taking the conversion route. Because see, we can two routes available with us. Either we can buy the shares directly from the market, or first we buy a convertible bond, okay, and get it into converted into the shares. So we are taking the convertible route. Okay, so when we take a convertible route, of course we have to make some more premium payment, and this premium is 550. Okay, we are making the not premium, it is we are making 500 550 we are paying for one bond. For how many bond we are paying? Okay, for how many bond we are shares we are paying? We are paying for 25 shares of price of each 20. Okay, ultimately, so for 500 rupees shares, we are paying the 550. So accordingly, we are paying somewhere 50 premium. Okay, so conversion premium we are paying for the share is 10%. Okay, clear? Now we come to the next last question of this case scenario. It says that the conversion parity price of the stock is, conversion parity means at what price the investor will be indifferent towards buying the share from the market or taking the conversion route. Please note that conversion parity price means it is that price of a share at which the buyer is indifferent in buying the share from the market or taking the conversion route. So very simple, 550 maximum, because he will pay the maximum price of 550. For this he is getting the share of 25. Accordingly, for each share he is paying 222. So if in the market the current price of the share comes, instead of 20 it comes 22, so it will be, he will be indifferent. He may or may not go for the convertible because it is the same price. So the correct option is C. So I hope with this, student, now the case scenario 1 clear to you. Now I am coming to the next case scenario. Let us read it, then I will solve it. It says that Growmore Limited, an NBFC, is in the need of funds and it sold the receivable to MAC Financial Corporation MFC for rupees 100 million. MFC created a trust for this purpose called General Investment Trust, through which it issued securities carrying a different level of risk and return to the investors. Further, this structure also permits the GI to reinvest surplus funds of the short term as per their requirement. Okay, it is so each line. See, these case scenarios from the chapter number 7, that is securitization. Okay, so here each and every line is very important to consider because it will help us to quickly answer the MCQs. Generally, this approach is also used in securitization, is used in the NBFC. Okay, because whenever they are need of fund in their balance sheet, the outstanding receivables are standing. So what they do, they sell it. So they sold it MAC Corporation, whatever there. Okay, Max MFC created a trust. Okay, it is also called SPV. Okay, called General Investment Trust. So General Investment Trust is a basically SPV. That is now here exactly we can say that the process of securitization has started. Very important to note that once they have sold it, we can say that sold it, just not a process of securitization. Securitization means when you create a SPV for the receivables, through which it issued the securities carrying the different level of risk and return. Now here when they are issuing the securities, so somewhere we can say that it is not a pass through. Whatever it come to me, I will pass on to you. Rather they are creating different tranches. This is called tranching. Okay, and here there in tranching there is a concept of waterfall, wherever whenever whatever the payment comes into this SPV, it is transferred to the various financial instruments. So what are the tranches possibles are there? Now let us, if we see the what are the tranches is. Now generally tranches are, if we see that lowest risks to highest risk, subordinate, or we can say mezzanine tranches, and then equity. So see here we have created different tranches. Generally these are created to bear the credit risk. Now if any on any part we can say that risk is there, that is the receivable does not make the payment. So it is the equity that will bear the highest risk. Of course for this he will also get the highest return. Okay. Now let us see what I start answering the questions. Now MCFC also collected a third party safeguard private limited to collect the payment due from the obliger and pass it on the GIT. So they are somewhere kind of a receiving and paying agent. Okay, it will also follow up the defaulting obliger if required. They will take the appropriate legal actions against them. So somewhere we can say that they are taking care of all the businesses. Okay, from the information given above, choose the correct answer to the following question. The securitized instrument issued for rupees 100 million by GIT falls under the category of. Now here very simple. In the earlier practice manual, in the study material, there was some I think error. Now on the web we have got corrected this error. Okay, so here the correct option will be the pay through certificate. Okay, it is not a pass through because we are creating a different type of. Had we have created a uniform, only all the one possibility that whatever coming to us we will pass it on to you, then it will be a pass through structure. Okay, in the हाँ अब काम कर रहा है। कितनी देर होगी? अभी भी हुआ है, पहले हो गया था? 2 to 5 मिनट हुआ है। अच्छा अच्छा, नहीं नहीं नहीं। Okay, student, now let us here. I'm just repeating. Now, in this case scenario, situation one, we are see here we have been given three situations: situation one, situation two, and situation three. Now, here when we have given the situations, so what we are doing, we are considering call option. Why we are see when our spot price is greater than our exercise price. So where the situation that way it will be exercised. So it will be in the case of a call option when our exercise price is less than greater than our spot price. Okay, so it will be and it is exercise. So it is clear cut case of a put option. Only in a put option we have a benefit, then we will exercise the same. Okay, now next is a lapse. Okay, in a lapse, when we will lapse it, when spot price is greater than our exercise one. So once we have gone find out what is the situations have been given, so it will become very easy to solve us the question. Okay, in the situation 3, the investor position and the amount of profit and loss is. Okay, so we can say that here the long position and short position both have a no meaning. Okay, it is not saying whether long call or short put, so we can also rule out this. Okay, only the option left is this one. Call is not ruled out and put option is there. So ultimately we can say that of course answer is there, but still we have to find out the profit and loss. So in case of a situation 3, what we have done, we have made a payment of premium of 25. Okay, and our exercise price is 300 or spot price is 400. Okay, so what we do, we will not exercise our option. Okay, so whatever a premium has been paid, that been lapsed, so this is the correct answer. Now when we say option 1, situation 1, that is call option, in the investor's position and the amount of profit, so ultimately these two options are ruled out. Okay, then this possible, call option and call options are there. Now here it says exercise price is this, spot price is this, it is exercise, so it means we are having some benefit. How much benefit we are having? 160. So this is the gross gain. Okay, this is the gross gain. Out of this we deduct the premium, so the nil. So the answer is this. Okay, student. Now moving to the next question. In the situation 2, that is which situation? In a put option, this has been exercised. One second, students. Now here in this second situation, put which has been exercised, the position. So first of all, we ruled out call option, call option. The possibilities are put options. Okay. Now when we say put options, here the exercise price this and spot price is this. Okay. exercise price, spot price is here, and we have exercise because see here we are getting a benefit because on the market we can sell the share at 175, but exercise we can make at a 200. So accordingly our profit is sorry 175. Okay, but we have how much premium we have paid? We have paid a premium of 15. Okay, so we deduct this premium. So ultimately net gain is this. So ultimately our answer is this. So very simple, student. Once you have understood the concept of uh, derivatives, I think there will be not a problem. Okay, then we are coming to the next question. This is a case scenario 4, and this is the last case scenario. This is not a last. This is on the based on the forex. Okay, foreign exchange exposure. This is a last case scenario. This is based on, sorry, a company is considering hedging its foreign exchange risk. It has made a purchase on 1st July 2024, for which it has to make a payment of US dollars 60,000 on 31st December 2024. The present exchange rate is US dollar 1 rupees 83. It can purchase forward $1 at 82. The company may have to make a upfront premium of 2%. The forward amount purchased, the cost of fund is 12% per annum. The company hedges its foreign exchange risk using the above mentioned foreign contract. So it means they have to purchase at 82 rupees. From the information given above, choose the correct answer to the following question. Now student, this question has come into our, I think it is in MTP. It has come into the MTP, there is some printing error in the solution. I will show you where you have to carry out the so how where the printing error, I just show you. I think there is no printing error. Okay, no problem. Okay, no student, there is no printing error. I thought it is, answer is correct. Okay, solutions have been given to you, correct one. Okay, so don't worry about the same. Okay, it says that if the exchange rate on 31st December happens to be 86 as per the happens to be 86 per US dollar, then due to forward position take, the company will, now you have to see, make profit or loss. Now student, please remember in this question, whenever this type of a question is there, please remember one thing. Here our forward rate is 82. Okay, the company is they have to make a purchase. Okay, so and if they are in a market, the rate is higher. Okay, that is 86. So it is a clear cut indication that you are saving some profit. Okay, now if you are not hedged the position, then certainly you will be at the risk. So certainly you have made some profit. Okay, so it is clear that you have made some profit, but here we have a doubt whether we have a make a profit or not, because here we have to check whether whatever upfront premium we have paid and what will be the cost of fund on this giving the logic of this cost of fund is that you have to incorporate this in your calculation. Okay, so accordingly what we do, we calculate how much profit or loss in the overall transaction. So first of all, what we see, how much overall outgoing or what is the cost of forward contract. So because it will be used in most of the upcoming questions. So forward position cost. So this is our hedging cost. Okay, this is our hedging cost. Now here, if we have make it has come to 86. So how much profit we have made? 86 minus 82. On this we minus this. So this will be the profit. Okay. If the exchange rate is happens to be 80, so here basically we have made a loss because we have taken a position on 82. So ultimately we have paying the 2 rupees more. But what add out to our losses? What the premium we have paid? Here we have deducted the premium. Here we will add the premium to our losses. So how much is our losses? Premium cost is 104,304. Okay, simply the answer will be this. If exchange rate on 31st December 2024 happens to be rupees 88 per US dollar, okay, then due to forward position take, now here we have a more profit. Okay, so how much profit we are having? So the correct option is this. Okay, student, now with this we come to the one part of our discussion that we have solved our case scenarios. Now quickly, since it is your examinations are near, 2 or 3 important very points I would like to share with you. First of all, please don't avoid the theoretical portion. Okay, it is a still you have some time, you make some your small notes. Okay, regarding so far as the numerical questions are concerned, you are almost tried all the questions by attempting it. Now you just start winding up your syllabus, because at least if you are taking the 6 papers, so you have to say somewhere you have to divide it into, I think only 4 days have been left. Okay, so 4 to 5 days have been left for each paper. So please you have to allocate judiciously your preparation time. Next, very important, there is a confusion regarding, sir, up to what decimal point we have to round off the answer. See, as I told you, if any instruction have been given in the question, we have to follow the religiously. Don't deviate from it, otherwise you will lose the marks. Second very important point is that uh, if nothing has been mentioned, so you take a clue from the question. You take a clue from the question. How you take a clue question from the question? In case of a forex, one second. In case of a question on forex, you have to see up to what decimal point they have given the rates. If the rates are given up to 4 decimal points, of course you have to do the same. And now in case of a like other questions, security valuation, it is better you round off up to 2 decimal points. Generally, price or the bond or shares are generally quoted in terms of up to 2 decimal point. But however, if you are computing the duration, here you can use up to 3 decimal point because duration matters a lot. Then next comes your capital budgeting. In capital budgeting, the figures are in your lakhs. So lakhs or millions. So generally, if you can take here up to 4 to 5 decimal point, there's hardly any harm because here rounding off and multiplying the million matters a lot. Now, so far as your other, like in case of a mutual fund, so in some where some questions, most of the questions we have rounded up to 2 decimal point, but in some questions you will see that here they have taken up to 3 decimal points. So you can, by logic, you can use a 3 decimal point. No problem. Ultimately, final answer will be same will be there. And in case of a questions on other questions, I think they will not face any problem. And especially in case of some questions like security valuation, where there is a confusion regarding D1 or D0 dividend given. So if dividend expected is given, so of course you have to assume it is as a D1. Okay, dividend paid is given, you can assume it as a D0, or especially if it is given in last year dividend. Now simple dividend means anything you can assume, we will consider the both options. So don't get confused in the examination on this point. So student, with this I am coming to the end of this session. More we have already covered in our classes as well. So with this we are coming to the end of this session, and if you have any query, so you are free to ask us, otherwise we will wind up the session. Okay student, thank you very much, and I hope you will come out with the flying colors and you will be the chartered accountant. Next year you will be the member of the ICAI, not the student. Thank you very much, and my best wishes to you for your examination. Thank you very much.
भार्गव जी, हेलो.
What happened?